We want like the juicy stuff.
What do you think about this thing, right? And his answer was BS.
A very small group of people actually understand the meaning of money. So I think you're the perfect person to ask this question.
Finance exists because the people that actually have the money are not necessarily the same people that have good ideas on how to spend it, on how to use it. You increase your allocation to bonds on leverage, so you're amplifying the bonds return. And what that does is, yes, part of your portfolio is levered up, but actually your risk is lower. The average company in the S&P 500 is levered itself 2x. This is the part where we say it's not investment advice. I'm bullish Bitcoin, but I'm not bullish Bitcoin the next year. So crypto is clearly a risky asset. So we are not really there yet. The inflation is still quite high. People talk about ETFs, but really it's not open to retail yet. It's not. If you are like a retail investor and you are in America and you want to ape in, I'm not in crypto to make 10%.
What is your personal investment strategy for this bull run?
When you look at your wealth, right, you should invest 80 to 90% of that into a beta portfolio. 10 to 20%, just do alpha. I don't like to pick things that I don't understand.
全世界最顶尖的基金跟交易员在评估投资的时候啊，不是只看眼前可能的收益，而是首先考虑风险，用各种手段来避险。你可能也听过嘛，但实际上他们到底怎么做呢？今天这一集的来宾超级硬核，因为他曾经在全世界最赚钱的避险基金 Ray Dalio 旗下的桥水工作。现在他把传统金融最精细的操作带来币圈，不过要先提醒大家哦，这一支影片的知识含量极高，非常考验你的金融常识，听不懂可能要多看几次，你一定会学到很多很扯的顶级操作。
Hello, hi everyone.
You used to work in traditional finance, right? What exactly that you did?
I worked for a hedge fund called Bridgewater Associates. I know people might have heard of Ray Dalio. I worked in his company in research, which is kind of like the department where he worked. So I worked there as a financial engineer, like an analyst, for about 5 years. I was in the credit team during the European financial banking crisis. So we were doing models and indicators and so on for Eurozone aggregate stuff. Why were things happening the way they were happening? What would happen in the future if a bunch of things rolled out in the way that we thought they would. Then after that, I launched a robo-advisor in a fintech company, which arguably didn't go too well, but it was a cool concept. It was around essentially, democratizing an investment, a passive long-term investment strategy called risk parity for everyday investors. And then Silicon Valley as a product manager, also in fintech for several years before essentially I ventured into the world of crypto.
Wow, that is a crazy resume you got right there. Okay, let's go back to the traditional finance because recently there's this TikTok video that went viral. It's there's this girl says, I'm looking for a man in finance. I don't know if you've seen that.
I'm looking for a man in finance with trust fund. 6'5", blue eyes.
Well, my question is there a hierarchy in this world? For example, bankers, investment bankers, who look down on who? We want the juicy stuff.
Besides the income part of it, which is probably why. Yeah, I mean, so things might have changed, but when I was working there, I would tell you definitely the number one in the hierarchy in the dating situation, would be an investment banker, right? If you were working for an investment bank, you were, surprise, making the most money during that time. Imagine the investment banker, this super alpha male, double squared alpha male kind of guy.
Wolf of Wall Street.
Yeah, but buff, right? And then you ask yourself, the thing I always ask myself is where do these guys find time to work out? They're working 100 hours a week, right? That's the guy. That's the figure, right? Below that, I would say maybe at the same level, but a little bit below hedge fund guys, specifically managers and so on.
Where do you see crypto bros fit in this hierarchy?
It's a good question. I don't know. It's a little bit of a controversial answer as well. It depends on kind of what the girl is attracted to, right? Is it
that is true.
Super alpha, strong, dominant men, right? And then you go traditional finance, investment banking. Is it more of a beta kind of guy that has a ton of money and is super nerdy? Then maybe you go for crypto, I would say, hyper generalizing things.
What was your crypto journey like? How did you become the CEO of MARS Protocol Foundation?
But when I was working at Bridgewater, actually most of 2013, basically I learned about Bitcoin. And I actually went to they have a team which is called the FX team that just works on currencies. And I went to them and I went to a specific guy, I'm not going to say his name, pretty high up there. And I said, what do you think about this thing, right? And his answer was, I don't know if I can curse here, but his literal answer was, it's BS. I should not say the full word. And the reason why it's BS, he gave me the reasons, right? Which, to be honest, were pretty valid reasons, but were kind of short-sighted. But to be honest, I kind of agree with him on most of what he was saying. They were thinking about it as like an alternative to a currency. And Bitcoin has pretty much almost no property of a currency. It has more properties of a store of value, which is a little different right now, because I was very dogmatic about this thing, but I kept monitoring it. Bitcoin's got all these problems. Over time, what I learned is like with technology and with human will, you actually do solve problems. And if you throw money at it, you put like really good people at it, you actually solve problems. And eventually like Ethereum came and became programmable, right? On Ethereum. And then the next thing that came was decentralized stablecoins, right? With the Terra, arguably massive epic failure of UST, right? Luna. But that was kind of like the moment for me. Okay, I've been proven wrong on these things. They actually occurred. This is really exciting. This is really what I want to be doing. And that's kind of like when I made that kind of leap, right? And I joined Delphi Labs.
Let's take a step back, because I feel like a lot of people in crypto, they're trying to redefine finance. And a very small group of people actually understand the meaning of money. So I think you're the perfect person to ask this question. What is the meaning of money?
I think there's two levels to this question. There's a practical meaning of money. Money is really an amino exchange that is actually simple to use, meaning it's like there's all these properties, right? I'm just give you a bunch. Like it's not like difficult to transfer. It's not like it can be split in smaller fractions. One important principle is that it doesn't change value too much over time. Concept of inflation. It does a little bit of predictable inflation. And the value of that is really that what's the value? Is that people can actually do different jobs and they generate value in a specific way. They can kind of like the value is represented. It can be all represented in this kind of like minimum exchange. And therefore, like, if I do something and I'm not selling you the service of what I do, I can be paid in a minimum exchange that I can actually use for something else, right? For example, like, if I'm a plumber and you don't need plumbing, but I need to buy fruit from you, I get paid in this minimum exchange, and then I pay you the fruit, right? It's kind of like the value, right? The practical value and meaning of money. But there's really a second level to this question. It's like, what does it really mean to have money? I think it's more of a psychological question. And assuming that the money that you actually accumulate translates in wealth, meaning it doesn't depreciate too much in value, and that there are very limited externally imposed ways to not allow you to spend it. I'm not going to talk about countries that have that. So capital restrictions, overtaxing and all that stuff, right? Then money can actually equal freedom. Freedom because ultimately you have control over your life, and it gives you options really to decide how do you spend your money to do what you want.
So with that explanation, the next question will be, what is finance? Why does it exist?
I'll give you like the one sentence and then I can expand on it a little bit. Finance exists because the people that actually have the money are not necessarily the same people that have good ideas on how to spend it, on how to use it in a way that's virtuous for society. That's really the concept behind finance in its pure original form. If I have money, and this is depreciating a little bit over time, but that's not necessarily an incentive, I kind of want to give it to someone else that can actually make my money increase. And that person that doesn't have money, but has a really good idea, maybe he wants to invent the next, quantum computing thing, right? He doesn't have the money, right? So he needs to get it, right? So you essentially give it to that person. So what you're doing is you're taking some risk, you're giving it to that person who is essentially going to use the money to invent something in society potentially needs, and therefore increase that money and give you back your part plus some amount, and keep the other amount himself becoming richer, you increasing your wealth, essentially being paid for the risk that you took, and overall in creating this virtuous like growth in the economy, and where essentially everybody can benefit and the overall average wealth increases, right? Because this guy has invented something that's useful and has made our life better. And that incentive is the interest rate. If you cannot charge an interest rate, you're not going to be incentivized to take risk. So the question is like, how much is that? And the risk here that your investment is, then now how you need to be compensated for that risk.
Yeah, that's a very perfect example. And you talked about leverage in one of your videos. When people hear the word leverage, people always think, oh, we're talking about like trading on crypto exchanges, 50x, 100x, and you get liquidated. It's dangerous. It's risky, right? I can't say they're wrong, but a lot of times there are a lot of common practices that people see and they don't even realize those are leverages. What is your definition of leveraging?
The way I define leverage, and it's just not just me, right? But it's just a tool to amplify risk, which results essentially in a potential higher return or a higher loss. So you amplify your risk by taking more risk, but why do you do that? Because potentially you can make more. In the same way, you can lose more. To get the other part of the question, so yes, you can think of leverage taking like a crazy crypto 50x, 100x. That is basically effectively gambling, right? You're gambling, right? You're an extreme gamble. But that's not the only way. First of all, most professional traders actually don't do 50x. That's more like retail at home. I want to gamble thing. I want to throw my money on. Yeah, it's like you go to a casino and you throw your chip on red, right? It's the same, right? You have a 1% move, you get wiped out. Most professional traders actually trade 2x, maybe most 5x. Really, you got to think of going back to the example of trad. Like this tool, actually, if you use it well, it can actually result in better, what's called in finance, risk-adjusted returns. What that means is for the same amount of risk, I have higher returns because I'm using leverage in a good way, and I'll explain that in a second. Or for the same return, maybe, 10%, I am having less risk because I'm using leverage in a good way. And a really quick example is stocks and bonds, going back to traditional finance. I think most people know what those are. So you buy stocks because they're higher risk and they're higher return. So you make 9% return on average on the S&P 500. But if you buy bonds, that are lower risk. So the idea is people that are old buy bonds. And if you're young, you buy stocks. And bonds of lower risk means, you make 3-4% on the same amount of capital. So now, if I'm an investor, I want to hold both, but I'm not going to hold bonds if my goal is 9% return. I'm not going to do that. But what does that mean? It means that on a year that bonds do really bad, I get wrecked. And I would have loved to hold bonds. So this goes as diversification, right? So how could I diversify in a way where essentially I have exposure to both, but I still getting the 9% return? You can use leverage. You can risk adjust the bonds. So you buy $100 of stocks, and then you buy on leverage $100 of bonds. And what that does is that you actually buy more than $100 because it has some higher volatility. But basically the point is, you increase your allocation to bonds on leverage, so you're amplifying the bonds return. And what that does is, yes, part of your portfolio is levered up, but actually your risk is lower because essentially they're both targeting the same return, but they're diversified. So on a year that bonds do well, stocks might do terrible, and vice versa. And your long-term return is 9%. I'm getting too much in traditional finance, but that's one thing. A little bit of leverage allows you to achieve this, right? A little bit of leverage, a little bit of something tends to be good. A lot of it tends to just wreck you in every possible way, right? To finish up, leverage is present in the everyday world. So give you a couple of really practical examples. The first that comes to mind is mortgages. I buy a home, I borrow from the bank, I put down 20%. I don't know much it's in Taiwan, but in America, for example, it's 20%. That means that the bank gives me the other 80%. I'm levered 5-1. I have a 5x leverage position, which is collateralized by my home, but that is leverage. Right? It's 5x, by the way, so it's not very little. Now, another practical example: if I buy a stock, an American stock in the S&P 500, Apple or Google or whatever, right? I have leverage, even though there is no trading on leverage, perps, no fancy instrument that I'm using. I am levered, and the reason why I'm levered is because the average company in the S&P 500 is levered itself 2x. So
I didn't know
essentially, that. Yes, they have leverage themselves, right?
Can you touch on why is it levered 2x?
Oh, it's very simple. It's your balance sheet, right? So your amount of essentially your total assets are 2x of your net worth. So they borrowed some amount, right, from the banks and so on.
Right. Wow. Yeah. So everything is levered, really.
Yeah. And what do you think the financial crisis happened in 2008? Because these banks were taking an insane amount of leverage, right? So so they got wrecked.
So now talking about leverage, we want to talk about futures, right? A lot of people in crypto, they trade futures. And why does it exist?
Perpetuals is what you're referring to in crypto. They are essentially the equivalent of the future. The difference is the future is dated. Perpetuals is not, which is kind of like a great innovation of crypto. Futures really came into existence because it's really important to think about derivatives in terms of two players, right? Two people that are taking different leg of that position, right? So on one side, you have a speculator, which is a person essentially, which is not necessarily a bad term, right? People think, oh, a speculator, you're bad. You're not bad. You're just taking bets. You have a view and you want to make money and you want to take leverage on your view, right? It's fine. If the economic system where you're trading is well designed, essentially you're actually really important functioning piece of it because you're providing liquidity. So you have a speculator on one side, and on the second side, essentially you have a hedger, an investor, essentially a risk taker and a risk reducer, right? That's the way you need to think about these instruments. Now, back in the days, this started with farmers. I kind of knew what the price of corn was right now, but my harvest would happen in 6 months, a year, whatever, right? I would have to plan, right? Do some financial planning and say, okay, I'm assuming that, I'm selling, I don't know, like $100 a bushel, whatever it's called. And I would need to plan with that in mind, right? Now, the price of corn at the time of the harvest of selling might change, it might go up or might go down, right? So if it goes down, I could potentially get wrecked and I would fail. My business would fail and it would be over. They invented this instrument called the future, where essentially you could, as a corn farmer, you could hedge the other side by going short the future, which means you would lock in a price, which also meant that if it went up, you would not make that amount they went up, but it didn't matter for you because you planned on margins, right? You say, okay, I can make this margin, and you wanted stability, right? So you were taking off risk the table, right? On the other side, who was taking the other side of the position? Someone who believed the price would actually go up, right? So a speculator. So that's kind of like why they invented futures originally. And I think it's the Chicago Board of Trade that started that in America.
You said crypto market, the capital is inefficient. What do you mean by that?
Going back to this concept, this idea of hedging. And like in crypto, you have perpetuals, and in crypto, essentially you have people that are like, trade perpetuals, and then you're going long the perpetual, you're going short the perp. What I meant to say is that there is a lot of speculation, and there's not enough hedging or like reducing risk. That's kind of like what I meant, right? And you see this a lot more. I would say there's a big difference also between centralized exchanges and DeFi. In centralized exchanges, you have really the big innovation that FTX brought to the market before they blew up was this concept of a sub-account. So they didn't really invent anything new. They just took what existed in traditional finance, which is brokerage accounts that are capital efficient, and they replicated it in crypto. It just means that for the first time, you could actually have this account where you would deposit any token, Bitcoin, Ethereum, whatever. They would all act as collateral, and then you'll be able to open perp positions with that collateral. It's not just with stablecoin. That gives you this massive capital efficiency where essentially the perps will be what's called cross margin. So the P&L of one perp could be used as collateral for a second. The bottom line is that if you were on the other side of the hedging side, you were doing this thing that Athena does, the basis trade, that's very famous right now. You were like an investor that was hedging risk, and you were getting really good risk-adjusted return. You doing that, it was translating in lower funding rates. So if you were a speculator, you were getting essentially also really, really good funding rates that allow you to speculate at a lower cost, which is what you want as a speculator.
What are some common ways to hedge in TradFi or crypto?
In crypto, one way we discussed is basis trade. But another thing is delta neutral strategies, which I would argue they don't really exist in centralized exchanges. This is an opportunity, I think, just for DeFi.
Explain.
And in DeFi, essentially, you can actually hold what are called LSDs, depending on who's calling it, liquid staking derivatives, liquid staking tokens. This is essentially is if you're holding, if you have Ethereum, and you don't want to forego the staking yield, you can actually deposit this in Lido, for example, and you can hold ST. And so and then what it does, it accrues the yield. That specifically rebases, but that's the point. You have this liquid staked version of Ethereum, and you can hold it, and it moves like Ethereum, but it also accrues on top, essentially, the yield, which is great because you can use it in DeFi protocols as collateral. So when you have this in DeFi, now what you can do, you can actually do really cool things if you have the capital efficiency that we discussed, where essentially you can deposit into an account your STE, and then you can go short the perp for the same amount. What that will do is it will remove completely the Ethereum exposure, and now you're getting risk-free, close to risk-free, like delta neutral. You get Athena plus a staking yield, basically, right? That's one example. Then you have other examples. You can do levered lending. So if I'm on Aave and I'm lending essentially, say Atom, right? You're getting 15% APR, which is pretty attractive, but you don't really care about the Atom volatility. You don't want it. You just want 15%, and maybe you even want that on leverage. But so same concept. You deposit it into Mars, you hold it, you're getting 50%, you go short the perp, and all of a sudden you're getting 15% plus the funding rate, right? These are great hedging, what I call investor opportunities, right? As an investor, you're coming in and you're just like getting really good at risk-adjusted return in crypto. In TradFi, there's other things you can do. It's conceptually similar. What you do is, if you buy a government bond on an emerging market, for example, I don't know, Turkey, and it's in US dollars, you don't really want to get exposure to what's called the nominal rate underneath. You just want the credit risk exposure, right? You just want that additional 5% that you get over the US government bonds. So what you do is you buy that, on leverage, you essentially borrow the US government bond, you short it, and then you do this, what's called duration adjusted, that's the term. And then you isolate just that what's called risk premium. You just isolate that. You can do the same with equities. You can essentially, just give you an example. You're bullish Nvidia, pretty priced in already, but you're bullish even more, and you want to essentially go short the sector, you want to isolate that stock, right? But you want to protect yourself from like a market downturn, a broader market downturn, right? So what do? You go along, buy essentially Nvidia, and then you essentially go short the sector, and you have to adjust this by a little bit. And what we'll do is that since Nvidia essentially is supposed to do better for you than the sector, then you'll just isolate that component, which then you can also lever up by using government bonds. But the point is like you can hedge out things and then make specific bets or reduce risk on one side.
Mind blown. Do you know what this feels like? It feels like I'm watching Harry Potter. It's like you're doing all these cool stuff, and I'm like, wow, that makes a lot of sense.
They're just like what hedge funds do, and then professional traders do. Yeah.
Do you hedge differently in crypto in bull markets and bear market?
This is the part where we say it's not investment advice. That side is still not investment. Do your own research. So the concepts are the same. When you abstract away from like the mechanics, the concepts are the same. You're isolating your risk premium, or you're essentially reducing a specific amount of risk. But what I would say is this. When there is a bull market, what generally happens is, let's talk from an investor perspective. You don't really care about essentially holding a specific asset because you don't want to speculate. You just want to get the best risk-adjusted return. So from an investor perspective, which is where hedging comes in for the most part, if you think about it, during a bull market, people are more bullish. So what that translates into is higher funding rate. So people are just going to want to take more crazier bets on Bitcoin, Ethereum, and all these what that translates into like it's higher funding rates, which means that if you do the carry trade, which arguably you can do through like on STETH and BTC, you can do through Ethena and Ethereum, you'll be able to do it in a much cleaner and simpler way. But the point is like really higher risk-adjusted returns. Ultimately, you'll get a higher yield for roughly the same amount of risk. So that's what you can do during a bull market if you're an investor. Now, if you are doing a bear market, what happens during the bear market? People like are more risk adverse. So you'll start seeing a lot of flight to safety, the crypto equivalent to that. So that translates into people just converting their tokens in stables, depositing the stables in the money market. And then the money market, you'll see this, the money market like APR for those stables, like lend APR just goes down like a lot, right? Even below like the US risk-free rate, which is a little crazy. So then what do you do in that case, right? Actually, in that case, leverage through margin, what's called margin, which means you're essentially borrowing USDC and you're essentially buying stuff on leverage, becomes actually cheaper. So you can actually do this same basis trade, but you can actually do it on leverage. You already are doing a leverage because shorting the purpose leverage. You can amplify that even more by essentially, given that your return is going to drop because the funding rate is going to drop, maybe it drops from 30% to, 5-10%. Like you can amplify this because what you do is you borrow USDC and maybe you're paying 3%, and you increase your position on, is it Atom or whatever it is. You adjust it, right? Like, when it's the bull, you don't need to use additional leverage. And when it's not a bull, you can essentially like use USDC as leverage, additional leverage to amplify the return. That's one thing you could do. What Mars is doing is building essentially a vault protocol sitting on top of Mars, where essentially anybody can come in and build these vaults, third-party vaults. Some are going to be like users with reputation building. So some of them are going to have the basis trade. You can just go in and ape in that vault, see it, and just do it that way. So kind of like an automated vault that essentially you can go in, you can deposit your assets and your tokens and stables, and essentially getting the same thing as a professional trader would do with a basis trade. What Mars does, remember this, we discussed about the sub-accounts, right? In trading in centralized exchanges, is taking this concept, and replicating it in decentralized finance under a new primitive, a money Lego essentially, which is called the credit account. And this credit account essentially replicates what you have, in these sub-accounts. It gives you the same capital efficiency, which means you can hold any token as collateral as long as it's on chain, right? As collateral, you can take any per position, they're cross-margin, they're cross-collateralized, but it goes beyond that. It's even better than a centralized exchange because unlike a centralized exchange, you can hold specific DeFi primitives that only exist in DeFi as collateral. So, for example, Uniswap pools, LPs. In our case, we don't have Uniswap. We have like Astroport, which I actually think is better because I believe passive concentrated liquidity is better. Holding that as collateral in your account. So essentially, if I want to ape in some, LP pool, providing liquidity in a good way, like with passive concentrated liquidity, but I want to use that as collateral to take on a per position. I don't want to exit because I want to bet on Bitcoin. You can deposit on Mars and you can open a Bitcoin long position. LP of vaults can act as collateral. Any primitive can act as collateral on Mars. But it's actually more than that because the account is a primitive, but it's a money Lego, right? So you can actually build stuff using the account to wrap around on top of Mars. And so that's the innovation. So it's really thought from the ground up with this concept of capital efficiency and extensibility.
You talked about hedging earlier, right? How do I hedge on Mars protocol?
It's the simplest thing in the world. It's like one click and you do it.
Really?
So yeah, it's simple. You have a credit account. You want to do the basis trade, really 2 clicks and it's done, right? You go in, you go on Mars, you deposit, I don't know, WSD, which is available on chain on Neutron. You just deposit it. Actually, you don't even need to do it. You deposit USDC on Mars, and you're coming from Ethereum. You deposit USDC through CCTP. It should be pretty seamless. Then it will mint for you an account in the background. You don't even know. And then now you see that you have USDC. Then one action, deposit. Second action, you go in, you essentially swap that USDC for WSD. Third action, you short the perp for the same exact amount. And you're done. You're collecting the basis trade now. You're hedging out.
You guys have been around for a long time, many, many years. And you are a part of Terra ecosystem, right? And of course, we all know the ecosystem collapsed, but you survived and you worked through. And tell us the story.
I was sort of saying that I wasn't part of the original Mars team. I joined, which, we're the number one contributors for Mars protocol. But I was there. I literally joined, and after 2 weeks, 3 weeks, or what, the collapse occurred. It was rough because keep in mind, like, everybody had a lot of capital, their personal capital and wealth. They saw it completely wiped. These were contributors that they had locked tokens, right? They didn't really, they didn't see it at all. And they lost massive figures. I imagine myself, I was an investor in Terra and I had quite a bit. So you had that stress going. On top of that, the people were getting liquidated. People there was just a total mayhem. They just needed to support the thing. So they were making sure that the protocol was working fine and people were getting liquidated orderly and all that. People would want to get out. On top of that, there was a lock drop, which means that people had their money locked in. So they just really quickly tried to, through governance, of course, because that's the right way, to kind of unlock that liquidity so people would just get it. They were just working over hours, doing insane things with the stress on top of what was happening, which was clearly not their fault. And then on top of that, when all that happened, we just took a step back and we were we tried to look at it objectively. So what's our next step? I mean, clearly the first thing that comes to mind is, where's the liquidity? Ethereum layer 2 is Ethereum layer 1. So a lot of projects from Terra did that. Under Labs, Delphi has a great research arm, and it's to me one of the top research companies in crypto. So we talked to the researchers. We looked into what we call the hive mind, and we did research. Okay, what is the best place to go? And we ended up going full circle that Cosmos was the best place for us to go for a variety of reasons. And then we looked at our vision and we said, okay, where's the vision of Mars? What do we want Mars to be in the long term? Best place to trade in crypto on leverage, rival centralized exchanges experience, and make it even better. That's the goal. Let's go build this, basically.
Just to build on what you just said. So choosing the chain or ecosystem to build your project on is like choosing which country you want to build your company, right? For example, if a chain has a very large total value lock, then that means this country is probably very rich and it's good for business. So with that logic and with the story you just told us, why did you choose Cosmos? Why didn't you pick, for example, ETH?
Clearly, the most attractive thing that you can think of when you're building is where is the TVL? Where are the users? Where is the TVL?
Yeah.
And again, a lot of people did that, and that's a way to go. But when you do that, you have to be conscious of the fact that it's not going to scale in a good way. So if ultimately what is your goal? You could consciously say, well, I'm going to go on a chain where on a layer 2, right, there's a lot of TVL, that can attract more users, more TVL, and then what's the mid to long-term game, right? Because that you're going to go there, you're going to have to leave at one point. And the reason is because for a DeFi protocol, it's not scalable in the same way. It's not just scalability, and it's configurability. You don't have that in the same way that you would have it with an app chain. So you're not really sovereign. That's the right word to use in crypto. You're not sovereign. And that is actually extremely important for a DeFi protocol, because it's not just about sharing block space, which is the problem to an extent. Could be a problem. It's not necessarily a problem. But it's also you need these customizations that are just good for you or for other DeFi protocols, which the chain is not going to give you, or they're not going to respond to you, right? So the reason why DYDX left, for example, Ethereum world, and they went and built their own Cosmos chains is exactly that. Sovereign ability, the ability to be sovereign, to adjust their chain in a way that essentially allows them to build the product that they want to build, the vision that they have. They're really chain agnostic. They're just we want this product, we want it to be the best product possible. How do we get there? We need to be sovereign. That was the reason, because then they can customize it in a way with the off-chain order book, with all these things, that they're useful for them. So in DeFi, you really need control of your stack to build a product that in the mid to long term allows you to be successful and achieve the scale if you have a vision of a product. It really boils down to, your vision on what do you think a great product should be. To me, the vision that I have is not too different than anybody X guys have. It's ultimately you're building a product and your user goes to your product because you have an awesome Ideally, the user goes to Mars protocol, for example, doesn't even know that it's on Neutron chain, right? It just comes in like through HTTP, like uses like, our integrated wallet, for example, or use MetaMask, right? And it's just like, okay, great. That kind of experience where essentially you're going to the product, you're coming from Ethereum, you're coming from the centralized exchange, and you don't even know you're there.
You're the expert. I want to ask you, how do you maximize or optimize the profit on Mars?
To give you an example, I'm bullish Bitcoin. Again, not investment advice. I'm bullish Bitcoin, but I'm not bullish Bitcoin the next year for a variety of reasons. We can talk more about that. I can either ape in a certain amount of money directly and buy BTC, right? You can do that on Mars, by the way. You just buy WBTC. So, which by the way is issued natively in Cosmos, the same way that it is issued natively on Ethereum. So you're getting it's the same experience, the same risk, but you buy it, right? And you hold it. But that's, is that really attractive? Because I do want to take some leverage. I think Bitcoin has a lower potential than these altcoins, right?
Yeah.
So what do? I can buy a perp, go 2-3x leverage, which could be reasonable, right? But the question is, do you want to do that? Because that means you're taking on a negative funding rate for the next year, which means like it's probably going to eat in your returns by 30 or 50%, right? Or even more. It's probably not the right way of doing that. So the right way, if you have essentially this like mid to long-term view, is to use margin, which means you can essentially, you borrow stables, and with that, so you deposit Bitcoin, you borrow USDC, and you increase and you swap it for Bitcoin, and you get like 2-3x leverage. People do this manually through money markets like Aave and so on. On Mars, you can do this with one click, margin trading, one click, basically. So that's what I do, for example, because I'm bullish Bitcoin the next year. You can now see Bitcoin go to $30,000. But no, that's one way. Another way, if you're short term, you want to place bets, you just like open perp positions. Another thing you can do is these vaults, you can deposit into these vaults. And another thing that you can do is with the drop launch, which is a really big catalyst that's happening on Neutron, which is the train where Mars is built on. Drop essentially is a liquid staking derivative protocol, but this one is particularly interesting because it is backed by Lido. So Lido is the number one TVL for DeFi protocol in crypto. Part of the drop launch, there's going to be a points campaign. They call them droplets, and you'll be able to go on Mars and farm these points with leverage. And some of these opportunities are going to be delta neutral opportunities. So you can just go in and just get isolated exposure to the points. And there's going to be probably vaults that are going to be built that you just ape in and you just farm the points. Basically, you don't even need to understand how to do it manually.
Okay. Anything else that you want to tell us about what you're currently working on, or which stage this project's at?
We essentially have this V2 launch. We call it V2 launch, where essentially we're going to have these credit accounts on Neutron. We'll have this third-party vault protocol built on top. It's going to be, I think, one of the best experiences in DeFi. Then we'll launch a public testnet for perps as well. While this is happening, we'll also do that. And it's going to be an incentivized testnet where you can come in, and if you find bugs, there's going to be a bugs bounty. You'll get rewarded in Mars. We're also going to have a competition. Top trader that makes the most money, the highest P&L, will get rewarded in Mars. Trader that gets the worst P&L, you get wrecked. Go in and get wrecked as much as you can. You'll get rewarded the same amount as a top trader, ideally. We haven't figured out the math yet, but it's going to be how I want that to be the same. Top guy that gets liquidated, so really the number one guy that gets wrecked in practice will get paid, will get Mars, and so on, right? It's going to be an interesting and fun competition. We're going to go people just like heavily using perps on Mars and then uncovering bugs, vulnerabilities, and things like that. And then we'll launch perps, basically. See, that will really unlock the capital efficiency thing that we discussed, basically.
Of course, we want to talk about your Mars token.
Mars token trades right now on two Cosmos chains for the most part. One is Osmosis. Then the second chain that we're on is Neutron, which is really where we're building our deep product. There, you have these two chains where you can trade Mars. I wouldn't be too surprised that if it starts getting traded also on centralized exchanges, the tokenomics of Mars, how we're changing it, we're revamping it, because it used to have an old tokenomics that came from the Terra days. So Mars, really, the way it worked was, after the Terra thing happened, we really wanted to make good our community. A lot of projects that just relaunched the token completely from scratch. We didn't do that. We essentially airdropped to previous Mars holders the token. We wanted to make people good. Okay, so on top of that, when we launched, we had like a Mars chain that, because we had this view that we wanted to get different chains and essentially have an orchestration layer through a chain. And then that didn't turn out to be the right decision, because we realized quickly that to achieve the best product possible, we really need to focus on one chain where we believe we could achieve it in the fastest way, and go really deep in features. So like this thing didn't work. So we decided to retire the hub, our chain, and instead transition the token through to Neutron. So which essentially is going to be the chain where token exists. We had a massive community pool. We decided to burn a significant amount because we didn't need it anymore to incentivize the validators. So essentially the amount of total supply is actually a lot lower than it used to be because of that. That just recently happened. So what we're doing is that we're going to essentially, the protocol revenue that will come through perps trading fees, borrowing fees, and liquidation, part of it will go essentially to a buy and burn. Well, essentially we'll buy Mars from the pool on Neutron, we'll burn it. And part of it will go to a buy an LP. This is kind of like what Maker does. Over time, we'll keep deepening liquidity on chain. So that's the token model. In terms of utility itself of the token, there's really two things. One was already voted in the proposal, which is going to be fee not rebates, fee discount. If you're an active trader, you can actually stake Mars and your fees get reduced significantly depending on how much you stake. Or if you're a vault builder and you want your vault APR to go up, you can actually stake Mars in your vault. And your APR is going to go up because your fees are going to get lower. That's the main utility of the token. There's going to be a second utility that we're talking about suggesting in governance to vote on probably later in 2025, which is yield opportunities. Some yield opportunities are going to be limited. We're going to have things like 7x leverage on leverage stake. It's going to fill up really fast because if you're getting 100% APR, like 90% APR, people are going to want to ape in. How do we create value for this scarcity? We'll do that through staking.
Okay, any alpha you can tell us?
So I would say, first of all, one piece of alpha, the way our perps work, it's Oracle-based perps, so they trade at the Oracle price. There's no order book, which means people can just come in and trade and they won't get wrecked, like on these other order books chains that don't have any activity. Kind of like it happens with synthetics or GMX and all that. But in our model, essentially, we have a counterparty vault model. It's not fully funded. It's counterparty. So essentially for us, so you deposit USDC and you're essentially allowing this perp platform model to work. You deposit into this counterparty vault and you get an APR. We're going to incentivize that through Mars. So when we launch it late August, you'll be able to ape in and get, pretty good amount of Mars through that. That's one piece of, I would call it alpha. And then I would say which is more interesting, that's towards the end of the year and 2025. We're going to try to create really, really cool visualizations and calculations on P&L. So we really want to be like a professional trader platform where essentially you go in and you see like your breakdown, how much money you made on this position, like how much money you made in your account. So like we're really going to try to bring stuff that I haven't seen even in centralized exchanges that I know that I've seen only in TradFi. Try to take those good practices and replicate them in crypto so that you actually have a really good breakdown and you can actually make better informed decisions.
Since you work in TradFi, in this crypto bull run, we see institutions coming in, like for example, Bitcoin ETF, and then now it's Ethereum ETF. Do you think this bull run will look different from our previous bull runs?
So crypto is clearly a risky asset. It's way more risky than stocks. And so then you have this massive liquidity that just like runs up to crypto. And then you get like these crazy soaring prices and it creates momentum and people come in and retail, oh, look, like Bowden is up 300%. So then they just start aping in. So we are not really there yet. Inflation is still quite high. And from a fundamental perspective, you can go, why? Ultimately, energy prices are high. But the point is like, it's not a favorable environment for high risk stuff. Like things are happening and then the central bank softened up on the tightening. So it really depends on how that's going to go, I think, from a macroeconomic perspective. And also there's a regulatory risk in the US. Most likely chance that will occur, that there are a couple of things that could happen, right? One thing could be the regulatory perspective gets better for crypto. And that is a great growth catalyst. Imagine like being able to open up DeFi to America. Because right now, for example, if you're using Mars protocol, you're like in your United States is blocked. We try to avoid Americans from using Mars because it's just not a favorable environment for DeFi right there. But if it becomes favorable, it's the number one market in the world. Then the second one I would say is energy prices, from my personal opinion. If they drop significantly, then you see also inflation, in my opinion, to drop significantly.
From what you just said, what I heard is you think this is not the bull market yet. Am I correct?
I don't think so. I think it is a bull market.
Right.
I think that the bull can be much more of a bull, like if we get favorable conditions, which is rates dropping, in my opinion, and DeFi regulation. These could be great catalysts, in my opinion.
I think it's really interesting how, Bitcoin has 4x since like the local low. And then people still think that bull market because we want to see everything go up. Like that craziness is what we define a bull market, right?
Crypto, it makes sense because the volatility is really, the risk is extremely high. So you're expecting much higher returns. I would also add, people talk about ETFs, but really it's not open to retail yet. It's not. If you are like a retail investor and you are in America and you want to ape in, for example, the BlackRock ETF, IBIT, I think it's called, you can't. Many platforms don't allow you to do that. They say it's too risky, blah, blah. And some people are transferring their assets away, but most people are going to be, okay, fine, whatever. When that happens, that opens up quite a bit of opportunity, right? But that hasn't happened yet. There's an ETF, but it's mostly institutions. And it's actually careful institutions, right? So there's still like a long way there to go, I think.
When people start aping in, like you said, usually it means the local top is here, right? And then that's probably when you should leave the market. How do you define people aping in?
A top signal could have been like this guy who called me and is like, oh, I'm buying Dogecoin because, it's backed by Elon Musk. That was kind of like pretty strong signal, I think. The truth is the signal there was the collapse of Terra. Right? That was the signal. And then the continuous collapse of the other things that were lined up behind it.
What are some categories you think will do very well in this bull run and why?
So the narrative of this bull cycle has been, in my opinion, two things. One is these meme coins. They've been doing crazy volatility. It's literally it's like a Ponzi scheme, right? Like you come in earlier, you make money, you get everyone. It has no intrinsic value, right? Now people are kind of gonna hate me for this, but it's true. People are tired of seeing exit liquidity for and so this is kind of their reaction. And the other thing that's been doing really well is still layer one. You look at these launches Celestia and and there's going to be others that are launched. I would say that it's just an example of layer ones that are coming out. The other one that's being quite phenomenal has been Athena, this basis trade thing, which to me is really not decentralized. It's a great product. So undoubtedly, right? And they've done really well. And I think they're going to do even better. So kind of the narrative, a lot of them have gone towards this real yield type of thing, which to me doesn't make sense. The reason why it doesn't make sense is because I'm not in crypto to make 10% on a volatile token. I am not. I'm in crypto to make 10, 20, 30, X, whatever it is. Not me, but the average person. And so if you're giving me stable yield, I don't care. Much better to have a product where essentially, it's going to go back into a buyback or something that will pump the token. I think some of these guys are going to understand this, I hope, and they'll readjust their tokenomics. As they grow and maybe they change their tokenomics, they can potentially become attractive. But I think there's another narrative which is more attractive. It's interesting, is the merging of crypto and AI. There's this kind of narrative, which people say it's a little bit self-fulfilling, which is basically, that AI agents are going to be the number one crypto users and all that. I think it's true, though. It's true because it's simpler for an AI agent to actually use crypto as a means of exchange of value and store of value. That's a big narrative. The question is, how far can that go? What are the use cases and all that? But that's something that I think the next big narrative, I think.
A lot of AI tokens, though, they're more like meme coins, at this stage, right? How do you identify which one is actually valuable investment to make?
You need to see who's building towards those use cases, what the team is, right? How much they've raised, who's backing them, and then what their roadmap is if they can share it. For example, Mars can't share it for legal reasons, but some people do. So I think that you need to do your research and see who has the best backing and who essentially is actually executing towards the thing that you think are the proper use cases that will generate value.
What is your personal investment strategy for this bull run? How are you planning on making the most out of it?
A big believer in the separation of the beta from the alpha of investing. This is traditional finance advice. It's not investment advice.
Right.
So essentially, when you look at your wealth, they'll say, okay, you need to have a certain amount in your safety fund, your rainy day fund. Generally, it's 6 to 12 months of your monthly expenses. You put that aside and you put that in cash. Then the remaining, you need to invest. You should invest 80 to 90% of that into a beta portfolio, right? And I'll explain to you in a second what that means. 10 to 20%, just do alpha, right? Now, the beta means essentially passive long-term investment strategies that will generate value over time. What's called the 60-40 asset allocation model. These are the Vanguard target fund. And then essentially 10 to 20% of your portfolio, it's alpha. And alpha is just bets. It's just things that you think are going to achieve value, and you are okay potentially losing all of it. So it's just your personal views. I look at crypto as my alpha portfolio. So what do I do there, right? There's different things that you can do. For me, I like to hold blue chips levered, like Bitcoin and Ethereum levered with margin because it doesn't wreck me, right? Not with perps. I tend to not have short-term views. I tend to have mid to long-term views, which in crypto is 6 months to a year. And then on the other side, I look at yield opportunities in DeFi. So things Pendle. And there's a lot of opportunities also with just stables. Right now during the bull, some stables are going up 15, 20%. That's kind of the way to look at it.
I think you might have answered the next question though, but I want to ask you again. So how do you pick and choose your crypto or your token? Is it different from, let's say, a person that's crypto native?
Some of the things are the same. So there's some similarities. I generally don't like to, besides the blue chips, which are conditions, right? The specific token bets in this 20% alpha that we discussed, I don't like to pick things that I don't understand. When I'm buying individual tokens, I try to understand essentially if it's something that I would try to use it. If I like it, I try to look at the roadmap, the team and all that. And if essentially to me it's undervalued, I buy it. That's what I do. But again, I don't have a big portion of portfolio in that. So on the yield opportunity side, I think it's trying to understand what the risk is, what platform it is on, what's the track record, how many hacks, like what is the risk adjusted potential return, what cut are they taking? And so I think it is probably different because I'm really I try to think always from a risk perspective.
But there's something different in crypto that TradFi doesn't have, which is people using NFT or the team is anonymous. Do you try to avoid that type of project?
The question is are they really anonymous? They're anonymous to you, that they're not really putting their names and things behind it. But why don't you take a look at who's invested in them? If it's institutional level VCs, they're definitely not anonymous. So they're anonymous to you and to the public, but they're not, because the VC essentially knows who they are. So if something happens to that team, they run away with the money, whatever it is, first of all, they have the VCs they have to deal with. I would be careful if it's not VC funded or if it's just this project out there and you don't know who they are and all that.
Thank you very much. That was very insightful. A great conversation.
Thank you. Appreciate it.
Really.
Thank you so much for having resisted this long. If you have, definitely follow Mars Protocol. I'm excited to have you guys on Mars.